Corn slipped again today while soybeans managed a small bounce. Cattle cooled off after a strong run and crude oil jumped, putting input costs back in focus. At the same time, lingering winter weather and soft export demand are quietly shaping cash markets underneath the futures. Those cross currents are setting the tone for how this week finishes. Good morning. Welcome to Boots and Bushels, your daily look at the markets that feed America. Whether you're starting chores, rolling down the road, or checking markets before the day gets moving, thank you for spending your morning with me. Let's start with where the markets closed today. Then we'll dig into weather, logistics, and the ag news that matters. Corn finished the day slightly lower, with March corn closing at 426.5, down about 1 3/4 cents. Corn continues to struggle to find upside momentum. This market is holding together, but it's not showing conviction. Funds remain cautious, and without a fresh demand, catalyst, or weather scare, rallies continue to run into selling pressure. Export pace is part of that story. Recent export inspections have been coming in near the low end of expectations. Demand isn't falling apart, but it also isn't strong enough to force buyers to chase the market higher. For producers, this is a market trying to build a floor, but it hasn't proven it yet. If support gives way, cash bids and bases could start feeling pressure, especially in areas with comfortable nearby supplies. Soybeans closed higher, with March beans settling at 10.67 1/4, up about 5.5 cents. Beans are managing to hold their ground better than corn, supported by steady export business and firm vegetable oil markets. Still, South American production prospects remain the weight hanging over this market. For now, soybeans remain range-bound until weather or demand shifts meaningfully. This looks more like a grinder than a runner. Wheat finished mixed to slightly higher. Chicago March wheat closed at 523.25, up about 3/4 of a cent. Kansas City wheat ended at 532.75, up about 3 cents. Minneapolis wheat closed near 560, up about 3 1/4 cents. Wheat continues to see short covering, but sustained buying interest remains limited without a stronger fundamental push. Live cattle pulled back today, with nearby contracts finishing 35 to 60 cents lower. After the strong run cattle have had, today looked more like a pause than a reversal. Tight supplies continue to underpin this market, and that underlying story hasn't changed. That said, at these price levels, cattle remain sensitive to feed costs and broader market sentiment. If corn stays under pressure, it could help support margins longer term. Feeder cattle also finished lower, following live cattle down. Feeders remain expensive, and any shift in corn direction or demand expectations will matter quickly. Lean hogs were mixed to slightly higher into the close. The hog market continues to search for direction as it balances export demand against domestic consumption and rising production expectations. Crude oil surged today, with WTI finishing higher by roughly $1.38 per barrel. This is more than just energy headline. Higher crude feeds directly into diesel cost, freight, fertilizer, and overall farm input expenses. If oil continues to firm, it adds another layer of cost pressure producers will feel heading into the spring. The major winter storm that impacted large portions of the U.S. hasn't fully let go yet. Lingering Arctic cold remains in place across parts of the Midwest and eastern U.S., keeping cold warnings active and continuing to slow freight movement, livestock transport, and grain handling in some areas. This kind of cold isn't always flashy, but it matters. Snow and ice slow truck traffic, tighten short-term basis, and raise feed and energy demand for livestock operations. Meteorologists are also watching the potential for another follow-up system later this week, particularly across the Great Lakes and Northeast. Even a modest system could extend logistics disruptions in key transport corridors. River systems are also something to keep an eye on. Winter conditions don't always make headlines, but uneven flows and cold weather can quietly affect barge traffic and local basis levels along the Mississippi and Ohio river systems. Globally, improving South American weather continues to weigh on corn and soybean markets by limiting weather premium buying. In the news, USDA's recent cattle on feed data continues to support a longer-term cattle market narrative. Feedlot inventories remain tighter year over year, reinforcing why cattle prices have held strong even with today's pullback. On the policy front, uncertainty surrounding year-round E15 remains unresolved. With lawmakers pushing ethanol issues into broader renewable fuels discussion, longer-term corn demand assumptions remain unsettled. That uncertainty doesn't move prices every day, but it shapes how the market values corn demand over time. Meanwhile, farm groups continue pressing Congress for additional economic support, pointing to tight margins, high input costs, and rising financial stress across agriculture. Taken together, these stories point to a farm economy that isn't collapsing, but it clearly is under strain, with policy risks and input costs playing a growing role in decision making. Here's what to watch next. Markets are entering a window where weather can still surprise, export demand remains under scrutiny, energy prices can quickly impact inputs, and policy headlines can shift longer-term expectations. That combination keeps volatility on the table as we move deeper into the week. Thank you for spending your morning with me. This has been Boots and Bushels, your daily look at the markets at Feed America.